for years. I mean, during the whole pandemic and even after the pandemic, that has been an underappreciated topic in macro. It's increasingly understood, but I still feel like it's not fully conceptualized by a lot of market participants. Basically, the U.S. is now in fiscal dominance, which is to say a couple key things. One is that public sector deficits or public sector debt creation is now larger in most years than the sum total of private sector debt creation. So if you add up net new bank loans, net new corporate bond issuance, and even estimates of less liquid private credit deals, that whole arrangement is generally smaller in a given year than total federal deficits that year, total deficit, total federal Treasury issuance, and so the reason that's relevant is because the Fed's main tool for trying to either accelerate inflation and credit or decelerate inflation and credit is interest rates. Um, and so when they raise interest rates, they can generally slow down the rate of borrowing by making borrowing less attractive. And if they want to accelerate borrowing, they can lower interest rates and therefore try to provide a boost. The problem is the federal government's not really interest rate sensitive. A lot of their things are just locked in. They're going to borrow regardless of what interest rates are. And so the Fed's tools are less effective in a fiscally dominant environment. And if it gets extreme enough, it can actually be pro-cyclical in the sense that higher interest rates make federal interest expense larger and therefore increase the size of the deficits, which can be stimulating in some ways. And so it's a very different macro environment than has been the case for most of the past 40 years. We've been in fiscal dominance. Early stages was like 2018, 2019, but really more recently in a cyclical sense, the 2023, 2024, and still in 2025 period has been characterized by fiscal dominance.
Right now, US deficits are so massive they've overtaken all private borrowing combined. Bank loans, corporate bonds, even private credit deals. They're now dwarfed by federal debt creation. And here's the kicker, the Fed's main weapon, interest rates, no longer matters. The government's going to borrow regardless. In fact, every rate hike just makes the deficit worse. Lyn Alden calls it fiscal dominance. But what's really happening is a quiet financial coup. The Fed is being cornered into permanently financing deficits, while Janet Yellen drains the RRP and floods the market with short-term T-bills to keep the system afloat. Social Security's trust fund is being emptied, military spending is rising, and now even Powell's 2026 exit is being engineered to install a dovish replacement. This isn't normal policy, it's a stealth transformation of the entire US financial architecture, and it's already in motion.
Right now, there has been an uptick around the developed world, but the U.S. is a pretty significant outlier compared to, say, European countries or other Western nations. And there's a couple main reasons for that. One is, so for decades, higher public debt to GDP ratios from accumulating deficits have been offset by structurally declining interest rates. So, for example, if you double your debt level, but you cut your interest rate in half, your interest expense stays the same. And that's largely kind of directionally what happened for about 4 decades. And the Western world hit zero, in some cases negative, in the late 2010s decade. And then during the kind of heart of the pandemic lockdowns and the deflationary shock, the brief one, and that was basically at the top in the bond market. And now bonds, let alone higher rates, if they just go sideways now. Like, for example, Switzerland already managed to get their interest rates back down, but they're not really going lower than they were before. Now, we're kind of in this more sideways pattern, most likely. So you no longer have an interest rate offset to larger accumulating stock of debt, debt to GDP or debt in the absolute sense. And so that's one big factor that's gone now. So that adds to the deficit. The other one is that, and countries are on different time periods for this, but the U.S. Is really hitting its demographics cliff. And so Social Security had spent decades basically accumulating. So basically more was paid into it than was paid out. And in the late 2010s, we hit the peak there. It started rolling over. And according to the Social Security Administration themselves, for the next decade or so, going into around 2035, they're going to draw down their existing $3 trillion fund and push that back into the economy as there's the whole very large baby boomer generation is retiring and will be increasingly retired and drawing from that, with fewer workers to really pay into that. And so that is, pro deficits, pushing money back into the economy. And then there's other major factors. I mean, for decades, the U.S. and say NATO countries were reducing their military spending as a percentage of GDP. In the U.S.'s case, that was often basically that military spending was kind of going sideways, which, when you have a rising nominal GDP, would result in a decreasing military expenditure as a percentage of GDP. But because of a variety of current factors, we kind of hit the floor there, most likely. And now we're sideways to up in terms of military spending as a percentage of GDP. It's a little bit more notable in Europe, because theirs got lower to begin with for many countries. But even in the U.S., when you consider multiple, kind of extra bills and stuff supporting some of what's going on, that adds to the deficit. So a bunch of different things together have kind of culminated in the 40-year period of what we've been in, the monetary dominance coming to an end. We saw, for example, during the 2022 gilt crisis, the UK briefly lost control and required rather awkward central bank intervention, despite the fact that inflation was very high. So they had like the Bank of England literally had to cancel a speech on balance sheet reduction to instead do emergency balance sheet increases to put out the fire that was happening in leveraged gilt markets. The U.S. isn't in quite that vulnerable of a position, but we have occasional moments of vulnerability where sometimes the central bank has to step in. And we've already seen action by the Treasury to impact this. And so, for example, during Secretary Yellen's term, she issued a bunch of extra T-bills to fund the deficit at higher ratios than is normal. And that allowed them to, one, draw from the reverse repo facility. So basically pull liquidity that was already in there, get that back out into the banking system, so it doesn't strain the treasury market. And two, it's basically a cash equivalent. A T-bill is kind of like a cash equivalent. And so, various pools of capital can hold it with less risk, because you don't have to worry about the price going down substantially because of interest rate increases and all the volatility that's associated with longer term bonds. And so one thing you generally see in emerging markets, if they have trouble with like the long end of their bond market, because if say you don't want to lend to a emerging market government for 20 years, 30 years, or maybe even 10 years, they'll issue more short-term paper. And directionally, that's what we've seen from the United States. Scott Bessent, the current Treasury Secretary, originally talked about fixing that. He said, we're going to lower long-term interest rates and we're going to term out the debt. So far, they've not done that, and they've specifically talked about the fact that because interest rates are higher than they expected them to be, they've blamed the Fed, but for whatever reason, the interest rates are higher than they expected them to be. They're not terming out their debt. They're continuing with the T-bill strategy. In addition, they've already talked about that, when Chairman Powell's term comes up in 2026, or at least his chairmanship term, not his full term, they plan to put someone else in there that's more of a dove. That's more willing to put lower interest rates in place. So the combination of having a Fed that is somewhat supporting, whether they say it out loud or not, somewhat supporting, the large debt load, and tweaking their term structure. So there's not a lot of demand for long-term debt. They can issue more short-term debt, even though that's kind of a bad look. It's kind of an emerging market look. But they have that tool available to them. And then during emergencies, the Fed can step in and buy some. So while there certainly can be periods of volatility and pain in the bond market, I still think they have a ton of ammo for keeping the train on the tracks for any sort of investable time horizon. April was kind of the peak tariff uncertainty period. That's when markets really had a freak out because some of these very high levels of tariffs are placed. And if you look at Trump's economic advisor, Stephen Myron, he wrote a paper in March 2024 that talked about how to kind of rebalance trade. And one of the assumptions that they had was that during the tariff negotiation process, it would strengthen the dollar, which would offset some of the tariffs and also give the U.S. more negotiating power. That hasn't played out. We've had a weaker dollar during the tariff negotiation period. And overall, I think the negotiations have been more fraught than they expected. They've had to kind of back off some of the more draconian things. A lot of those are still ongoing, so we don't know where this is going to land. So far, tariff revenue has increased, but even with the increased tariff revenue, deficits are still very large. And so it's not although I wouldn't call it completely immaterial. It is certainly a smaller factor than the overall structural trends that we just talked about. So you could potentially get, 100 or 200 or maybe even 300 billion in additional revenue in a given year. You're up against like a 2 trillion annualized deficit. So around the margins, you can affect it, but that's still, it's still a background thing to deal with. It's more about whether or not a given industry is hit hard. And unfortunately, one of the ways it's played out is that, the tariffs go on companies, and then some of the really big ones get exemptions. So it kind of like the middle and the smaller companies are the ones that end up getting stuck with it. That's how a lot of government programs often end up operating. So yeah, a lot of that's still ongoing. It certainly impacts industries, even if on a macro sense, it doesn't really too much affect the fiscal dominance thesis other than around the margins. There has been some delays in the current negotiation, but then there's also increased rhetoric around it. During the sell-off that occurred around April, that reduced the administration's negotiating position, but the subsequent rebound throughout late April, May, and June, and now into July. So the fact that the S&P 500 is at new highs, the fact that the bond market's less volatile than it was back then, that does give the administration more, stronger position to try another round of tough negotiations. So I wouldn't be surprised that we entered another period of turmoil here to kind of see all these different entities and where they're going to negotiate with each other.
Now you know how this quiet financial coup transformed the Fed into a full-time deficit machine. But if you think that's the end of the story, it's not, because what comes next could flip the entire Treasury market upside down. So make sure you don't miss the next video right here on this channel. You're going to need it.